The internet is full of these blanket statements made by people who don't have any idea what they're talking about. And they say stuff like, buy this stock or buy VOO, but they say that just because Warren Buffett has said it. And in my former years of investing, I used to be swayed by the opinions of others. I would go on Reddit, I would check forums, I would look for confirming evidence, or I wouldn't even call it evidence, confirming advice to my own suspicions of how the stock market worked. And after I would buy the stock, I would be checking every day and I'd be like rooting for the stock. I'd be like, yes, go up, 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 up. Oh my gosh, it's down again. Comment below if you've had a similar experience. And so I really had to figure out a way to invest where I had peace of mind. In order to have peace of mind, the decision needed to pass a few common sense checks. And so today I want to share 5 ETF investing tips nobody really talks about. And some people talk about 1 or 2 of them, but they don't do so in a nuanced way. And so these are things that once you know are instantly implementable. They are easy to learn for beginners. And at the end of the video, I'll give you like the golden takeaway. Like if you forget everything in this video, this is the one rule you need to remember. But understanding all the 5 tips from this video will give you reasons for believing in and acting in accordance to that golden rule that I will share with you. It's not the only one, but today I'm going to share one of those golden rules. Okay, so tip number 1 is you want to identify the assumptions that you made that justify your investment. So every statement you make, you assume some things to be true and some things to be false, right? So for example, if I make the statement that vanilla ice cream is the best ice cream flavor, then I am assuming that, to me at least, that chocolate ice cream is not the best ice cream flavor. In the same way, if you make the statement that Tesla is going to be the top stock in the automakers market, then you are assuming that other companies like GM will never catch up. Okay, and so that is an example of an assumption that you assume to be false, right? GM will never catch up. But there are also assumptions that you assume to be true, right? So for example, if you assume that Tesla will continue to be the top player in the market, there are probably a few things you are assuming. You're assuming that EVs will continue to increase in popularity. You're assuming that Chinese EV makers will find it difficult to breach into the international market. You are assuming that the self-driving technology that Tesla is coming up with will be a top player in the market. You are assuming that all the side projects that no one really talks about, but Tesla is invested in, will become profitable product lines in the future that will successfully diversify and de-risk the firm from its sole focus on EVs currently. And charging stations, I guess. Charging stations make up a small part of the money. So those are examples of identifying assumptions you made that justify your investments, okay? So all of those assumptions work together to form a thesis. And the thesis is the idea that, or the argument that if you buy the stock of the company, that the company will continue to remain profitable and increase in profitability over time, right? And so that's why you're making those assumptions. And in order to see whether those assumptions rest on sound premises, you then have to do the legwork to see if Tesla is gaining market share, to see if there are tariffs that prevent Chinese EVs from entering the American and European markets, to see if, in case EVs do enter those markets successfully, are they actually better or worse than Tesla cars? So you have to think about the assumptions that justify your assumptions that justify your decision, which sounds complicated, and as it should be. But that's why we talk about ETFs, right? So when we invest in ETFs and not individual stocks, when we invest in an ETF like VOO, there are a similar set of assumptions that we talk about. And so we're now not worried about individual stock assumptions. We are concerned with the overall market, because the assumption when we invest in VOO is that no single stock can disrupt the whole ETF in general. So Here's the assumption you make when you invest in VOO. You assume that the American market will continue to do well over time, that the American economy will continue to grow over time, and that the American dollar will remain a powerful currency in the world over time. Those are kind of the main assumptions that you make when you invest in VOO. And so if you ask yourself those questions and the answers are yes to all of those, then you have sound reason to invest in VOO, and you shouldn't be checking the market every single night. And in general, I believe that those are sound assumptions, that the American economy will continue to grow, that American companies will continue to be profitable, that the American dollar will continue to be dominant at least in the next 15, 20 years. If you cannot stand reasonably behind your assumptions, you shouldn't invest in the first place. All right, second rule, you want to minimize your fees, which you've heard, but there's a caveat. Only if you think the ETF won't beat the market. And so some ETFs have objectively beaten the market over time. You might be thinking, what? Those exist? Yes, they do, right? So you look at like an ETF like QQQ, which has pretty low fees, justified. Or if you look at an ETF like XLG, they've both consistently beaten VOO over a longer period of time. And so XLG, for example, has a higher management expense ratio than VOO, but it's justified because it's beaten the market over time. And so some fees are okay, actually. Most ETFs have low fees in general compared to mutual funds. And so you're pretty much in good hands if you buy ETFs, unless they're really actively managed. Now, tip number 3, ETFs probably don't diversify your risk as much as you think it does. Yes, you are diversified away from a lot of company-specific risk, but stocks as an asset class are correlated with each other anyways. And so if there's a stock market crash, your equity holdings might be down 40% in like a few days. And so you actually only diversify risk when you buy assets that are uncorrelated with each other, which theoretically would lower volatility but cut into potential returns on an overall portfolio. Most stocks are correlated with each other, and so if you actually want to diversify, you need to be considering different asset classes that work together. The all-weather portfolio by Ray Dalio is an example of this. So there's a combination of bonds, there's a combination of gold ETFs and commodities, and so that's why people have Bitcoin in their portfolio. That's why people add real estate to their portfolio. That's why there are alternative investments like businesses, artwork, wine, and all these other things that actually work together to create this overall diversified portfolio, okay? And so you don't want to be thinking about your investments in terms of just stocks. You want to be thinking about your investments in terms of anything that will generate you a capital gain or income over time, yeah? Anything, really. Trading cards, if that's your thing. Stamps, if that's your thing. Coins, if that's your thing, right? Cool. Number 4, fourth tip, you want to ignore, now this is a personal preference, you'll see the pun, you want to ignore all ETFs that appeal to only your tastes and preferences. So there are themed based ETFs. They're nice, they make you feel good, right? Like, I only invest in environmentally friendly companies. But unfortunately, the only thing that drives stock prices is people buying them. And the biggest reason that people buy stocks is because they think it will go up. And the biggest reason that a stock's price will go up is because it will be more profitable in the future, right? And so if you invest in theme-based ETFs, then all of a sudden you're ignoring the profitability of the companies, and you're just caring about this initiative, this ideology, for the lack of a better word, which is irrational, right? And investments are rational decisions, or they should be. Number 5, ignore leveraged and inverse ETFs as sole investments, and mainly due to their tax efficiency. Okay, like, I'm not going to argue whether or not covered called ETFs are good investments or not. I think there's a time and place for them as a hedge within a portfolio, as a part of a much more complicated strategy that, you know, one day I might dive into, but right now I'm not too interested in. And so you shouldn't be either, and especially not as a sole investment. Like, if you were to put your whole life savings on a yield max NVIDIA ETF, that is in general not a good bet to make with your life savings. Yeah. If you want to test the waters with like 10% of your net worth on individual stocks, on covered calls, on different investment strategies, just to try it out, then do it, right? No worries. But don't bet the farm on what you don't really need, okay? That's just gambling. You know, like even if you think the NASDAQ will go up, you shouldn't be buying a stock that tracks the 3 times daily return of the NASDAQ, because it won't work out to be a 3x return over 1 year. Yeah, because that's just not how math works. And these ETFs are likely frequently traded, right? So within the ETF, there's high trading activity by the portfolio managers, and so they might create a lot more taxable event. Okay, so what does this ultimately mean for you? So we're gonna come to a golden rule, right? And the golden rule has a few assumptions, right? Remember, we operate based on assumptions which we think are sound. And so we don't invest in short-term ETFs, and we stay rational and not really think about our taste and preferences. We minimize fees, but with the understanding that we only do so if we want to perfectly track the market and get an average. And obviously, we identify the assumptions that justify our investments. So taking all these 4 considerations in mind, and keeping in mind of the diversification of ETFs or lack thereof, here's the thing. If you don't have a reasonable thesis for beating the market just by VOO or VTI, this is the heuristic, right? Yes, it's the advice that you've heard from everyone else. And the reason it's advice you've heard from everyone else is because it works for most people, because most people won't sit down and think about the assumptions. Most people won't sit down and think about diversification and asset allocation. But if you're most people, then, well, VOO, VTI, QQQ, SCHD tracks pretty much the whole market and just accepts average returns over the long term. Now, if you're obviously in your latter years, combine your portfolio with something that pays dividends or pays a fixed interest or coupon and have some cash so that you can weather stock market crashes. But aside from that, if you don't want to do the work, then settle with the average return.